All right, welcome back. So this week we'll be looking at chapter 11 and we'll focus on the cash flow statement, where we look at the direct and the indirect approach to the cash flow statement. With the cash flow statement being part of the financial statement that companies will have to prepare and disclose to the public if they are listed companies, there is a certain way that we prepare the statements. So typically we use two methods, which could be the direct method or the indirect method. So you're going to cover those two approach in chapter 11. The direct method is relatively straightforward, but the indirect method requires some adjustment to the net profits. Here is an example. Typically, before we go into this example, we have three sections in the cash flow statement, which is the operating activity, the investing activity, and the financing activity. In the operating activity, this is where you record all the income that is received in the ordinary course of the business and all the expenses that was paid in the ordinary course of the business. What we refer to as ordinary course of the business, it means that that is what you typically do from day to day. If, for example, you are not into the business of lending money, you are not a bank or finance company, but you choose to lend money and you receive interest in that, that won't be considered as the income from ordinary activities. That could be recorded as part of your cash flow in the financing section of your cash flow, but not in the operating activities. So in this example, if you look at this, we have depreciation of $5,000, we have account receivable $2,000, and we have the account payable $3,000, and then the net income is $50,000. So what we are going to do using the indirect method, we are going to adjust all things that were not related to cash, and things that were not related to cash that we are used in the income statement preparation, where we add those things back to the net income. And those that were not cash related, that we probably would have deducted or we did deduct, we'll have to deduct that from the net income. So with this example, if you just pause this video and read through this context we have here. So in adjustment to the income statement, for example, depreciation doesn't involve income or it doesn't involve any actual cash flow. So what you do in that case with your net income statement, you add back your depreciation to your net income. So the increase in accounts receivable, for example, it does mean that you have sales that you have not collected cash from. That also counts towards the profits you recorded here. So what you typically do in that case, because this has not really involved any cash flow as such, you have to minus it from your net income. For the increase in accounts payable, that would have been accounted for in your expenses in your profit and loss statement. So because it doesn't really involve cash, but we use accurate accounting basis, we recognize that as an expenses. In this case, we'll have to add this back to the net income in order to derive the net cash from the operating activity section of the cash flow statement. Now, the next one is your investing segment of the cash flow statement. So for example, if we look at this case, say you sold an old delivery van for $10,000, you bought a new piece of machinery for $25,000. The net cash flow from investing activity is going to be $10,000 minus $25,000 of the new machinery you bought. So basically the cash you receive by selling your PPE, which is plant, property, and equipment, it could be disposal of scrap, or it could be sales of your existing equipment. You minus any new equipment you purchase from it. Typically, in most cases, this is usually negative value, but there are also at times where the company has a significant sales of their fixed assets that could result in positive cash flow from the investing activities. And then the last part is the financing activity. So, for example, if you look at borrowing $40,000 from the bank and then you pay out $5,000 dividend, you have to reconcile these two because this has to do with financing. So you have cash you borrow from the bank, $40,000, which is cash coming to you, and now you pay out cash from your finance, and that is $5,000 for your dividends. So when you minus $5,000 from $40,000, That will give you a net cash balance from the financing activities of $35,000. At the end of the cash flow, you have to reconcile all those three sections. So in the operating activity, we have a net cash balance of $56,000. And then we have investing net cash balance of minus $15,000. And then in the financing activity, we have a positive net cash balance of $35,000. So when you add all of this up, that is 76,000 net cash increase based on the cash flow statement. What we expect your cash at bank to actually increase by $76,000. So we can verify that. We can look at how much was your cash balance in your balance sheet at the beginning of the year, which in this case is $24,000. And then you add cash increase from the current year to have $100,000 as your total cash balance. Typically, when we look at your cash statement from your bank, plus any cash you hold in the company, we expect the total cash available to be $100,000. So using the direct method, as I mentioned earlier, is relatively more straightforward. So basically, you look at the cash collected from customer, $150,000, minus the cash paid to suppliers, paid for interest, which could be interest paid on loan you have to operate the business. So when you reconcile these three, your net cash flow from operating activity will be $56,000. So where the difference lies is that in the indirect method, we focus on adjusting the net income. In the direct method, we focus on recognizing only cash flow or actual cash activities that we received and those cash activities that we paid out. If you do have any questions on this topic, feel free to reach out to me. But I think this cash flow statement is an exciting and interesting topic that you'll find really reasonable and practical. It also tells us in ways in which we can assess company liquidity in terms of how much cash they have, or asset test in terms of the ability to meet their short-term debt. So we could use the net cash balance from your cash flow statement to make different decisions or carry out some different analysis. So I hope you guys find this topic interesting. If you do have any question, reach out to me. I'll be happy to assist you.